So let us dive into this question that we've been wrestling with for about 47 minutes now, which is why stocks are quite as risk-off as they are, because, you know, European futures are a little weaker, but Nasdaq futures down 0.8%. Maybe there's a Bitcoin read across. There's the Japan story we've just been discussing in depth. I mean, what's your take on why things have started on the back foot in December?
Yeah, I mean, I think it's really just a symptom of investor cautiousness, all of it. And so you get pieces here and there that are maybe negative news, but maybe the clearest sign of that investor cautiousness is the amount of money you're seeing in cash. So if you think about the amount of money in money market funds, that's actually reached an all-time high on some measures. And so that tells me that investors are very cautious. And it does mean that that money could move into risk, but there are a few reasons in the near term it's probably unlikely. The biggest reason is just we have so much data, and so you're likely to get pinged around on that data. We're also very dovishly priced for the December meeting from the Fed. It's pretty much fully priced for a cut, and you're going to get some forward guidance from that meeting that might skew a little bit more hawkish. I think the other point is that, you know, the cash yield is pretty good, so why not just park there until you get further into December or into the new year. And then finally, you haven't seen that flow become stretched yet. So people aren't rushing into money market funds, and so there's not a reason for that to kind of have a reversal. I think it does mean that once you get past this data and you have a clear view on the economy, there is cash that can go into risk, but we're just not quite there yet.
Let's talk about Santa Claus. Is he going to show up? In order for him to show up and deliver a rally, do we need to see positive news, or is it just the absence of negative news, i.e. stability, that gets Santa to show up at my doorstep?
I think in this year in particular, you need some positive news to get Santa to show up on your doorstep. I mean, I would say that the Santa rally obviously is grounded in fact in terms of you do tend to see a rally in the last month of the year.
But it tends to be quiet. So low vol.
Exactly. You need to have some kind of fundamental reason for why that occurs, and it's because, you know, low vol, you tend to see you just go with whatever equities do, which is generally most of the time they go up. But because you have so much data now, you're not going to get that low volatility environment. So I think you need to be more cautious, and you need to see those positive signs. And I'm just not sure you're going to get them, because the number one driver that we've seen of equity markets recently has been your monetary policy view. And we're very dovishly priced there. And so I don't know how you get a terminal significantly lower than 3% without having economic data damaging that would also outdamage equities.
Yeah. Skylar, I'm in danger of having focused too much on the Mag 7 in 2025 and not enough on the wider S&P or wider global stocks. And certainly over the weekend of getting a reminder of that with lots of our stories talking about how some of the European stocks, in particularly Eastern Europe, some of those stock markets have done pretty well. I mean, what's your thinking on how European stocks have actually done pretty well when you look at the top 20 performing indexes over 2025? There's quite a lot of European names in there, and whether that's repeatable, whether that can continue.
I'm a little bit more pessimistic there. I think generally equities trade together. So if U.S. equities are up, then European equities are likely to be up as well. But I think there was a lot of optimism put into fiscal that was announced out of Germany in March. And there was this expectation that it would spread beyond Germany into other countries. And we haven't really gotten that. And the fiscal that we have gotten out of Germany, a lot of it's not directed in the same way to stuff that has a high multiplier as we were expecting. And so as I think we head into next year, that growth is more likely to disappoint in Europe as you don't get the big fiscal spend that's been priced in already.
So the clock's gone to zero, but I've got time to ask another question. Don't ask me how that works. The dollar. What happens next with the dollar? You talk about the fact that we are quite dovishly priced on the Fed, and if we don't deliver upon that, do we get a stronger dollar? Because the dollar's been really important this year. The S&P in euro terms is up by 3.83%. The German market's up by nearly 20%. The IBEX is up by 41%. Europe has massively outperformed because of the currency this year. So what happens next year could be really important. If the Fed doesn't deliver, does the dollar go up?
Yeah, I mean, absolutely. When I'm thinking about currencies, the number one drivers are growth and rate differentials. From a growth perspective, I think it looks quite good in the U.S. right now. Yes, You've had the slowing of the labor market, but you're getting fiscal stimulus, you're getting monetary stimulus. You could get more next year, and that means you have more of a hawkish risk within your yield view. And so that means rest of the yields are up, especially as I talked about with that terminal at 3%, unlikely to go lower. Yep. And then I think, too, you just haven't seen this mass exodus from the U.S. market, right? AI means that you're still getting growth in the U.S. It also means that U.S. equities are relatively attractive. The yield on a U.S. 10-year or even bills at the front end is very attractive. And so that means people are still parking money in the U.S. And I think the story that we had at the beginning of the year where we had the end of U.S. exceptionalism and people going out of the dollar and the U.S. generally. You just haven't seen it in the flow data aside from kind of 1 week in April.
Okay, 1 week in April. We remember it well.